Over the next 10 minutes, I will not only tell you, but show you why stocks are going to fall over the next couple of weeks. I present this information more so as statements than questions because there is a lot of things we know for certain. But ultimately, there is no guarantee, even if I'm correct in what I say, that the markets will crash. So it's important to know I am not a financial advisor and come to your own conclusions. But let's start here with some of the data that we got today. Something just broke, and it broke around the New York area with the Empire State Manufacturing Index. This is the lowest number that you have ever seen, minus the Rona. This is a worse number than the Great Financial Crisis itself. In other words, manufacturing has just collapsed. We were expecting -5. The number came in at -43.7. If you look at the chart, taking out of the equation the artificial drop we seen during the shutdown of the Rona, you've never been this low. Even the Great Financial Crisis low, you hit about -37 or so. Now you're -43. As well as manufacturing, ISM services employment has also started to collapse. So the underlying economy might be in a bit of trouble right now. Tomorrow's economic data for retail sales month over month for the month of December will be a big test to see how the economy is actually doing. 70 to 73% of GDP is comprised by personal spending. You and me out there spending money in the economy. If we get a bad number tomorrow, the odds of a recession are going to jump big time. But believe it or not, the reason why I actually think a pullback, a correction or crash-like event is coming over the next couple of weeks has nothing to actually do with the economy itself. And ultimately, the way that we come out of this crash or correction event is by some Fed stimulus, in which we're getting more signs of here today. First up, I think it's very important to acknowledge stocks are trading at all-time highs. So this is not some kind of crazy prediction. Let's be honest. Stocks are probably going to pull back from here. The question is, how aggressive is that pullback going to be? In the near term, the big hurdle that we have is earnings, especially earnings at the start of a new year. You get a lot of companies that will issue full year guidance. Now, when you look at the expectations for EPS growth in the S&P 500, the average consensus estimate from Wall Street analysts is 11%. That's high in a normal year, in a year in which we're not facing a potential recession or not facing elevated bankruptcies or unrealized losses on banks' balance sheets or uncertainty about the path of the Fed funds rate or inflation. 11% high for a normal year. Also worth mentioning, big retailers like Walmart, Target, Dollar General, they have been warning of deflation coming over the next couple of months, and that's ultimately bad for margins and should negatively affect EPS for the S&P 500. But it's really all based on expectations. So if markets are trading on expectations of, let's say, $240 of S&P 500 EPS for full year 2024, and you assign a 20 times multiple to that, you're going to be trading pretty much at about where we are today. About 4,800. The S&P on Friday hit a multi-year high, the SPY, of almost 480. So you're fully priced in right now. The problem is, let's say earnings underwhelm and earnings do not come in good, and maybe S&P 500 EPS is 220. Times that by a 20 times multiple, then you're at 4,400. But as you know, the markets don't exactly trade on fundamentals all the time. So there is other things to consider, like the path of the Fed funds rate. Currently, markets have very high expectations of what we're going to get for rate cuts in 2024. Currently, markets are pricing in 6 rate cuts. That would be a rate cut at every Fed meeting, including March, besides one. So maybe a cut in March, a skip in May, a cut in June, cut in July, cut in September, cut in November, and cut in December. Based on what we're hearing right now from the Fed, that does not look likely unless one of two things happens. Either inflation plummets and falls faster than we're expecting, and then the Fed can aggressively cut rates. Maybe the economy holds up, maybe not. Second scenario here is the economy just outright starts to take a downturn. Then you'll get 6 rate cuts. Based on the last CPI report we got on Thursday, this last round of basically getting inflation from 3% to 2% is gonna take some time and probably persistent Fed funds rate. You can make an argument that housing is propped up right now, or rents, owner's equivalent rents, because the Fed funds rates are so high. So if the Fed actually starts cutting rates, inflation will fall faster, at least in the housing sector, but that's probably a topic for another video. So the problem in the near term is we have the next Fed meeting on January 31st. And if we're still pricing in 6 rate cuts and nothing has dramatically changed, the economy has not gotten worse, well, we're probably going to get a pretty hawkish Fed Jerome Powell. Fed J Powell is really going to push back on 6 rate cuts in 2024, and he might push back and say March is too soon to start cutting rates. And I think at this point, markets are pricing in a certain degree of we're going to get 6 rate cuts. Some stocks are trading off of that narrative. That is also a big problem in the near term for our markets. It's also important to note that this is pretty common to actually see markets trade sideways, if not downwards, in Q1 of an election year. Then you tend to have a pretty good mid-year crash-like event, correction-like event towards the election itself. And then after the election, stocks really tend to take off. Fed Governor Chris Waller said today, rate cuts are coming into view, but the process should be carefully calibrated and not rushed. As long as growth is fine, I see no reason to move as quickly or cut as rapidly as the Fed has in the past cutting cycle. So in a way, the market's pricing in 6 or 7 rate cuts in 2024 is already saying we're probably going to get some more weakness in the economy, in which these probabilities for rate cuts, that's priced in by the bond market. The stock market is not pricing in a recession or the probability being high that we go into a substantial downturn. Fed Waller also said today that his view is consistent with the Fed policymaker projections for 3 25 basis point rate cuts in 2024. Even one of the most dovish Fed officials is still only saying 3 rate cuts. So again, that's a big problem for stocks coming on January 31st. And to make matters even worse for our markets, the PE ratio of the S&P 500 is now 8 times the PE of international stocks. This is also concerning heading into earnings season. You are seeing insiders selling stock at unprecedented paces. Insiders have sold about $406 million worth of stock, and insiders have only bought about $3 million worth of stock. So a ratio over 20 to 1 is bearish. That would be like if, for super simple math here, if somebody sold 100 million worth of their company's stock and you only had investors buying 5 million, that would be considered bearish. So you're at 145 to 1. That would be like insiders are buying $1 of their stock or $1 million worth of their stock, and they're selling 145 million worth of their stock. That's not great. Because if anyone has an idea of what the new year is going to bring for their company, it's the people that work at the company. You're also seeing pretty much everyone is bullish this year. That's because basically everyone got it wrong heading into 2023. They were proven wrong throughout 2023. Now people think it's better to be bullish for 2024. Goldman Sachs says something finally breaking due to higher interest rates is unlikely at this point because the peak growth hit from higher rates and tighter financial conditions is well behind us. UBS just said today, we are increasing our 2024 S&P 500 target from 4850 to 5150. While earnings should drive 2024 returns, lower rates should support incrementally higher multiples. I could go on, but if you look at the average banks estimates for the S&P 500, it's anywhere from 5,000 on the SPX, SPY around 500 to 5,200 on average. That would be anywhere from 3 to 10% of a gain from here. We also have this statistic to deal with. If you look at the average return after the Fed cuts rates, it's a loss of 23.5%, and it usually takes about 195 days to fully bottom. I don't necessarily think stocks need to fall over 20% after March or May, whenever the Fed ultimately decides to cut rates for the first time, but historically, it's not a bullish event. Another big risk to stocks could be if we continue to see economic indicators, economic data coming in poorly, and that's why tomorrow's retail sales will be important. If that comes in worse than expectations, maybe way worse than expectations, stocks are not going to like that at all. But that is something I cannot quantify. I don't know when the economy will start to look worse and start to take a turn for the worst. Ultimately, when that happens, that's not going to be great if you are in stocks. The bright side to this is the second half of 2024 is setting up to be probably much better than the first half of 2024. And there's a couple different things you could look at here. By that point, we're going to know what we're paying for stocks. We're going to know what S&P 500 EPS growth is going to be. Hopefully inflation will be lower by then. The Fed will be already cutting rates. If markets do crash on the first Fed rate cut or two, that'll already happen. So we'll be starting from a lower place potentially and rising throughout the second half of 2024. But the big point to me is 2024 is an election year. There's going to be a lot of pressure to instantly start quantitative easing, to start cutting rates as low as they have to avoid a recession. Because if you go into a recession in what could be a close election like 2024, this year, that's not good. You are at a record level of household equity ownership. So about 56% of households in the US own stocks. If they are watching their stocks plummet right before a election, possibly going into a recession, yeah, that's like a poison pill if you're the incumbent president looking for re-election. That is your worst possible scenario. You would rather go to war. You would rather see high inflation than go into an actual recession the same year you're up for re-election. So I think rates would get cut back down to zero and we would risk hyperinflation before we went into an actual recession in 2024. And the first sign of stocks coming down, the Fed's going to U-turn so fast it's going to be ridiculous. The Fed actually, the last Fed meeting, put in their summary that stock prices could affect Fed policy as well. That is the first time they have done that in basically ever in recent history. From the Rona until now, they've never mentioned anything about stocks. If anything, they've said they want stocks to fall. But something has changed now that it's an election year and we are in 2024. So if we do get a downside move, some kind of correction or crash, it's highly likely the Fed's going to step in pretty shortly and start printing money again, making the money printer go burr, okay? Let's just be honest there. That's how that will work. Let me know what you think about this information down below in the comment section. Are you bullish? Are you bearish? Are you neutral? Are you kind of out the markets? Are you continuing to buy as normal? Let me know what you're doing down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.